Hello and welcome. In this on-demand video, OJM Group partner David Mandell outlines a strategy that physicians and other high net worth individuals can use to reduce capital gains taxes. If you have more questions or want to learn how to incorporate this strategy into your financial planning, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Hello, I'm David Mandell, one of the principals of the OJM Group, and today I'm going to be presenting how to avoid capital gains taxes like a billionaire. So let's jump into it. Okay, so the fact is that billionaires can often avoid the capital gains taxes, and you don't have to take my word for it. There's a number of good articles out there on the tactics I'm going to explain, or at least the strategy of what we call buy, borrow, die. And that kind of leads to the next slide. And four tactics that physicians can use, and maybe you already are using, and some that I use to reduce taxes. So here are some sites for you to go to if you're interested in reading more about how billionaires do it. I would recommend of all these, the Wall Street Journal article. I think that one goes into the most depth and has some good examples and really explains how wealthy folks are able to avoid capital gains taxes for years, decades, and even generations. So if you want to do that homework, you can. If not, let's just dive into exactly what we're talking about. So buy, borrow, die. This USC law professor, I went to UCLA for business school and law school, but I'm not afraid to quote the enemy over at USC. Once you're already rich, it's simple. It's easy. Just buy, borrow, die. These are the planks of the law have been in place for 100 years. And really the key piece of that is that we're not taxed on loan proceeds. We borrow money that is not income to us. So as long as we borrow, we're not taxed on that. And if you've got assets to borrow from, well, now all of a sudden you can access liquidity and cash without any taxable event. So the strategy, what is it? It means buy. For billionaires, this means create startups that become huge companies, but doctors can use this. I can use this, and I'll tell you how I do. This also means invest. Look at your balance sheet, okay? Borrow, simply borrow funds using the assets collateral. Loan proceeds have never been taxable under our tax code. I was just saying that. Yes, have loan rates ticked up over the last couple of months? Sure, they have. They're still relatively low over the last 30 years. And certainly we hope that some of the interest rate rising will have its intended effect, which is to slow down inflation. And then die. Now, since heirs get a stepped up in basis when they inherit, meaning if I buy a stock today at $100 and it grows to $1,000, let's say I bought it at 100 5 years ago, now it's 1,000. If I went to sell it, I'd pay gain on $900. That's the gain. If I hold it to death, let's say it moves up to 5,000, my heirs would inherit the basis at that $5,000 level. So they could sell it the next day for $5,001 and only pay tax on one, right? The basis for me in my life is 100. That's what I bought it for, basis. But the heirs get a step up in basis to the value at the date of death, which here we're assuming 500,000. So what they will inherit, my heir inherits at 5,000. If they sell it for 5,000, they'll pay no tax. What if they inherited 5,000 and a couple of weeks later, it's worth less and they sell it? They'll actually have a loss. Okay. Then they can actually pay back the loan, thus permanently avoiding the capital gain. Also, capital gains tax. Also, heirs may refinance and just keep the deal going. We'll talk about that. Okay. That's the simple concept. Billionaire examples, there's 100 of them. Okay. Just do some research. Fred Smith, there's an example. He is, at this time, this was in 2 years ago, July of 2020, he had a $600 million credit line against his FedEx stock. Why would he ever need to sell an asset or even take much in personal income? He can just use that loan proceeds at extremely low rates, I'm imagining, and not pay any tax. And that's what they do. Okay, Elon Musk, same thing, et cetera. So we're not billionaires. We're not CEOs of Fortune 100 companies. What can we do? Well, there's four tactics that you can use to put this buy, borrow, die concept in place. And we're going to talk about each. So let's take a look at the first tactic, which is second mortgages and HELOCs. The concept's simple. Rather than selling an asset, and that's what we're talking about here. We're not talking about shielding your ordinary earned income. Talking about having to sell an asset, incur capital gains taxes and state taxes to pay for some large expense. That could be a new home down payment. That could be improvements on a property. That could be college education. That could be a boat. Whatever you want to or need to spend money on, rather than selling an asset, incurring tax, do this. You can borrow money against the home, then pay it off as you want or not. Okay. Home equity line of credit. You make your payments. You can always pay it down earlier. A second mortgage with no prepayment penalty. You can always pay it down earlier or not. Keep that debt on the balance sheet. If it's a primary home, and that just gets into the death part, buy, borrow, die. Federal law requires the lender to convert mortgages to the heirs becoming the borrowers in many circumstances, meaning you could literally do this on your primary home, right? And then die. And then the lenders have to work with the heirs. There's some limitations to that, but in general, they do. They can't call the mortgage because of death. So again, this is a way we could all do that. And what's the result? The result is you paid no capital gains tax to be paid to access that cash, whether you pay the loan back, okay, whether your heirs pay it back, whether they work with the lender as required by federal law to continue the mortgage. Okay. Tactic number 2, portfolio loan. Now, this is something that has been extremely popular over the last couple of years because the lenders have gotten here. I've taken a portfolio loan. I also have a HELOC when I did some work on my home. So I've used the first 2 tactics. Now, this is exactly the same as what Musk and others do. I just mentioned Fred Smith. They're, rather than selling an asset, they're borrowing money against their portfolio. There happens to be a large block of their company stock, but we can do it with a general portfolio. At OJM Group, we work closely with Charles Schwab, who's our largest custodian in the world, and Goldman Sachs as the lender. In fact, I did this myself with my own Schwab portfolio and Goldman Sachs. And again, I get an extremely low rate. In fact, when I was looking at the HELOC, I get a much lower rate from my portfolio loan that I could get on my HELOC. Okay. And I talked to Goldman Sachs. In fact, if the borrower dies, they said they often get paid at close of the estate or they refinance with heirs. So it's the same thing. Either heirs can pay it off as buy, borrow, die, or they just kick the can down the road and keep that loan in place, especially if rates are favorable. So I didn't have to sell any assets when I wanted some cash out. I know another close colleague of mine used a portfolio loan to buy a home, a third home, all cash. So rather than going to the expense, closing costs, and all the trouble of trying to get a bank involved on buying a home, a third home, they were able to use their portfolio loan. The whole thing took a couple of days. The cash hits your account. It's really amazing. It's pretty much all online. And the rates are lower than mortgages. So really tremendous. Again, result, no securities need to be sold taxably to access cash. Goldman Sachs expects its lending business to the mass affluent and RIA clients. That's the kind of clients we have, mass affluent, like physicians, to hit $10 billion as wealthy takeout loans to cover taxes and all cash real estate offers, like I was just mentioning, a colleague of mine did. And that was back in November of last year. This is going on, and it's very popular. Buy, borrow, die tactic number 3, cash value life insurance. We certainly have other videos on this. There's chapters in our book of how to do this right, how to do it wrong, how to avoid problems, success factors. So there's lots of stuff we've written about and spoken about. I'm not going to drill all the way down into that, but just remember, cash value insurance has a cash value piece to it. It's not term insurance. There's death benefit, then there's cash value that can be tied to an S&P index, that can be tied to bonds, that could be tied to a mortgage kind of return. But whatever that's based in, beyond what you put in, you always get that back. So if I have a cash value policy, and I do, of hundreds of thousands of dollars, let's say I put 100,000 in premiums over the years, and the death benefit is $1 million. But now that cash value has grown to 300,000. I can always get my 100 back as return of basis. That's true of any asset, right? You put in 100 in any asset, you can get that 100 back. The difference is that next 200 of growth, I can borrow against that. maybe almost all the way up to that 300, not at 300, but maybe 280, 270, whatever the law and insurance company allows. And I can borrow it very favorably. One of my policies, and I have, is 25 basis points contractually guaranteed interest rate. So I'm borrowing against this cash value, even lower than the portfolio loans. Okay, 25 basis points, 0.25%. It's basically free money. And again, when I do that, I can either pay the back or I don't. Okay. In this example, let's assume there's $500,000 of cash value and $3 million of debt. If I borrowed out $400,000, okay, I'm paying less than 0.25%. When I die, let's say there's still $400,000 outstanding. I never paid it back. I never paid tax on it. I'm paying 0.25%. My heirs, instead of getting $3 million, they get 2.6 because the $400,000 comes out of the death benefit to pay back that loan. It's a great way to use the death benefit, quote unquote, during life. Okay. At contractually guaranteed rates. Now, one of the things you'll read about in our book is some policies, and some companies have policies that are extremely good for growth, but they're awful for distribution. Can you imagine that there are some policies, when mine is 25 basis points, that are 8%, 800 basis points, right? 32 times the interest rate, and a supposedly good policy from a top-rated company. So you have to understand what's in these policies, and are they good for growth? Are they good for distribution in loan rates? Or are they both? And that's what you're looking for, and that's why I have to work with a great agent like some of the folks in our team. But again, I can cash, and I'm going to be accessing these cash values as part of my plan throughout my life, 100% tax-free. And if you listen to our talks, watch our talks on tax diversification, it's absolutely crucial to have some buckets where you're pulling money tax-free, because then you're not subject to future cap gain and income tax rates. Last tactic is basically the last one, cash value life insurance, but on steroids. Okay. It's taking tactic 3 and growing its potential exponentially. Why? Because in tactic number 3, we just talked about that cash value policy I just mentioned. I'm paying for that with after-tax dollars. So I got to earn money, pay income tax on it, have less, and then invest into that policy for the tax-free growth and the tax-free loan access. But what if you could borrow money to buy that policy? Right? How many of us pay cash for real estate? Well, I mentioned a colleague of mine did, and people have been doing that over the last couple of years. Now, again, when she did that, she borrowed against her portfolio. So it was a loan. It wasn't cash. Again, the whole point here wasn't paying after-tax dollars, paying tax to come up with that cash. She was still borrowing against her balance sheet, but she wasn't using a mortgage. But the point here is, why, if this makes sense and interest rates are low, which they still are, maybe you borrow you borrow the funds to invest in such a policy, and then you use the cash value to pay off that loan, 8, 10, 12 years, et cetera. And then you've got a cash value policy to do exactly what I talked about, tactic 2, tactic 3, grow it and then borrow it out. But you didn't put all those premiums in. All you do is pay the interest, and then you had that cash value, pay it off. So same reason most physicians choose to use a mortgage person real estate, even if they could buy it for cash, other people's money, and the low cost of capital. Extremely popular over the last couple of years. I think even with rates ticking up, extremely popular because, again, don't want to get too technical, but a lot of these policies grow in lockstep with interest rates. So even though you might be paying a little higher on the borrowing of the interest rate, your policy may return a little bit higher anyway. So they kind of move together. Here's a diagram. This is a little more complicated of a topic, so I thought I'd give you a diagram. Here's, in this example, the bank loans the physician $500,000 a year for 5 years. The client pays interest only for 15 years. And again, we've seen interest rates at 2, 3%. They put that $500,000 in the policy. The bank is collateralized. That's why you have good loan rates, because they get 100% collateral in that policy. It's even better than real estate. They let that grow for 15 years. That cash value pays off that $2.5 million. And then the client, as they get older, can take $2.9 million out tax-free. And what we do when we show this to a client, this was a 55-year-old, we say, well, you have to pay that interest for 5 years. And this was 2.25%. So you're actually having to pay $750,000 or so in interest over those years. What if you created a separate what if you didn't do this? You'd still have that 754 in your pocket rather than paying that interest. That's the column 4 here. So what could you grow that to? Okay. If you didn't do this with your, with that accumulated dollars that you didn't pay in interest, right? If you didn't do it, you'd have those interest payments. You could have put it in an after-tax account and grown it. Well, you'd have grown it to $1.2 million and taken $1.2 million in distributions over that period. Instead, you're getting 2.9. So you're improving your situation, 1.7 million in after-tax distributions in retirement. Again, net of everything, you're $1.7 million better than not doing. Okay. Again, I went through this extremely quickly. The point here, let me step back, 30,000 foot view. We don't want you paying capital gains tax when you don't have to. You can act like a billionaire. There are 4 tactics to do so. 1, a HELOC or home a second mortgage. Some of you are doing it. Many of you maybe perhaps are doing that. A portfolio loan. This is something that some of our clients have done, that I've done. You might be doing it, might be something to look into. Cash value life insurance. Again, something I've done, something you guys could look into if you haven't already, get good advice on it. And then most beneficial potentially, but most complex is the premium finance. I haven't done that myself. Some of our clients have. All 4 ways to skirt capital gains taxes and use that buy, borrow, die concept, just like a billionaire. Thank you for listening.
OJM is a multidisciplinary wealth management firm. For nearly 2 decades, our firm has helped physicians across the U.S. reduce taxes, protect assets, and achieve their financial goals. OJM Group offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. We hope to speak with you soon. Thanks for watching.